Hello dear friends, I Professor Agam Dalal on behalf of JK Shah classes welcomes you all. Now, in this particular video we are going to do the analysis of the paper which was asked in July 2021, that is basically originally May 21 attempt, Inter CA direct text. Now what we are going to do exactly? For each question, what are the topics covered in that, what are the concepts covered in that, I have prepared one PDF for that and will quickly see those points so that it will be like a quick analysis. And those who want to see the paper of July 21, and even if they are not looking at the suggested answer, they are just looking at this PDF, they will be coming to know each and every concept which was covered by the paper. Before I move to that, the very first point to be noted is 100% provisions of the paper. I repeat, 100% provisions of the paper which was asked in descriptive questions, that was totally covered by the JK Shah classes textbook which were given to the students. 100% of the provisions are covered by JKSC textbook. Now, without wasting much of the time, let us start with the paper. See the paper in that section A, 14 mark for the very first question. Basically in this question they have covered PGBP chapter, they have covered IFOS chapter, some of the part of deductions they have covered, and some of the very good adjustments were also there. 14 mark questions were there in which surprisingly they have not asked 115 BAC. So 115 BAC was not there, even alternate minimum tax credit was also not there in this question. Now which important points were there in this question? First of all, interest on PPF is exempt. Interest on saving bank account was given on the credit side of P&L. You know that it is always the income from other sources. And for this income, you will get deduction under section 80 TTA. On the credit side of P&L, they have given interest on national savings certificate. Remember, it is taxable in income from other sources. And for that, you will get deduction in section 80C. In the adjustment, they have given family planning expenditure. But remember, the person who is covered in the question is Mr. Ashish. That means he is not a company, he is an individual, and family planning expense is deductible as per section 36 subsection 1 only if you are a company. So here you are not supposed to deduct this expense. If it is debited to P&L, disallow. In the another adjustment, they have given payment to sister-in-law. Payment to sister-in-law is not a relative. She is not covered by 40A subsection 2, and even though you are making the payment above fair market value, it will not be disallowed. Then in one of the adjustment they have given employee contribution to provident fund. Now see, the employer has deposited this contribution after the due date of that provident fund act, and if employer is depositing it after the due date of provident fund act, as per section 2 clause 24 it will become the income. But then as per section 36 subsection 1, you will not get the deduction. So this will be added to your income. Medical expense which is debited to P&L, disallow from PGBP. It is a personal expenditure. But then you have to deduct under section 80D because it is a deduction of 80D. Then commission. See, if you see the last line of the questions, they have given the professional income of Mr. Ashish for the last year is somewhere 52 lakh. Can I say more than 50 lakh? So in this year 194A, 194C, 194H, 194I, 194J, this 5 section TDS applicable. While making the payment of commission above 15,000, 194H is applicable. And if you are not deducting TDS and you are paying the commission to a resident person, 30% of that expense will be disallowed. So you had to disallow 30%. Then on books and computers, 40% depreciation is there. Furniture, which is debited to P&L. Furniture is a capital asset. How you can debit to the P&L? It will be disallowed from PGBP. But can I say for this furniture, you will get the deduction of depreciation. Now in that also, the payment of furniture, if you have made above 10,000, otherwise then by account, pay, check, draft, TCS or other electronic mode, you can't claim depreciation on that. Then motor car. See, if you have purchased building earlier and now in this year you are bringing it to the business, notional depreciation to be deducted, that is okay. But if motor car was purchased few years back for personal purpose, now bringing to the business purpose, the original cost of that motor car will only become the actual cost. On that itself depreciation will be provided. And last point which was there in the question, contribution to PPF, for which deduction under 80C will be applicable. So these were some of the important topics which are covered in this question number 1. If you just look at these topics, the entire question is covered. Then question number 2A, 6-mark question was there. In the JKSC textbook also we had similar kind of question. Now, here 2 points were actually covered. Number 1, you had to identify residential status, that is number 1. And number 2, you had to calculate the total income along with tax liability. See, according to me, yes, marks were little bit lower for this kind of question. It could have been for 7 or 8 marks, but they have asked for 6 marks. That is okay. Now here, Mrs. Rohini, aged 62 years, born and brought up in New Delhi. Can I say she became Indian citizen? And now she get married in Russia. So whenever she will come into India, an Indian citizen is coming to India for visit purpose. For an Indian citizen coming to India for a visit purpose, if her Indian income is less than 15 lakh, we have to check only one basic condition of 182 days. Only 182 days. Here, she is visiting only for 60 days each year. So by default, she become non-resident. And the entire question which we had to solve is based on the fact that she is non-resident. Now remember, for non-resident, only those income will be taxable in India if the asset is there in India, if the source is there in India. So the pension from Russian government, not taxable in India. But LTCG and STCG, which is belonging to Indian asset, taxable in India. Rental income belonging to property which is in India, taxable in India. From rental income, I hope you have not forgotten to deduct 24 clause A 30% standard deduction. One more point, life insurance premium is given in the question. Nowhere in ATC it is written that life insurance premium should be paid in India. And even ATC is applicable to non-resident also. So here in the question, for the life insurance premium, she will get deduction of ATC. However, your deduction under chapter 6A cannot exceed your general rate income. In this question, if you see the income, long-term capital gain on sale of land, section 112, 20%. Short-term capital gain on sale of listed share, 111A, 15%. The only general rate income in my question is rental income. After deducting 30%, whatever is the income, your total deduction cannot exceed that house property income. And then balance will be your total income. But while calculating the tax, don't apply shifting benefit. Don't apply rebate under section 87A because the person in the question is a non-resident. I hope you understand this. Then, question number 2B, as per their trend, again over here they have asked the question based on TDS. And you can see over here 8-mark weightage. And very easy questions they have asked. If you have read entire things which are given in JKSC textbook, nothing was out of the box. Nothing. The very first thing, just to make some of the points, 194M is applicable for those individual and HUF whose last year turnover was not more than 1 crore and 50 lakh. And in this year, if you are making the payment for contract payment, professional fees or commission over and above 50 lakh, then TDS under 194M will applicable. 194C will be applicable for those individual HUF whose last year turnover is more than 1 crore or 50 lakh if the contract payment is for business purpose and per year more than 1 lakh. However, if the turnover is less than 1 crore or 50 lakh in last year, 194H do not get attracted on commission payment, but those person automatically get covered under 194M. But in 194M, the threshold is 50 lakh. So if commission is made below 50 lakh, then again 194M is not applicable. Last point was related to cash withdrawal. 194N. If you withdraw cash above rupees 1 crore in the previous year from any bank or post office, whatever is the withdrawal over and above 1 crore on that excess amount, 2% TDS is to be deducted. Here in the question, the person has filed the return of income for last 3 years and that's why 1 crore threshold will be applicable in 194N. So that was the question totally covered in JKSC textbook. Question number 3, subclause A. 6-mark question is there. If you have done total income chapter from JKSC textbook and homework section, very similar kind of question we have drafted and we have put over there. One house is there for which 3 units are there. One is let out unit, second one is business unit, third one is SOP unit, self-occupied. You remember, whatever is the percentage of let out unit, of that, whenever calculating expected rent, take it proportionate to the whole house. While calculating actual rent, you have to give the effect of unrealized rent vacancy loss. Municipal tax to be deducted percentage wise. 24 clause A 30% standard deduction. 24 clause B interest on borrowed capital also percentage wise. Sir, in the question they have given ground rent and fire insurance. It is totally wastage. No use of this deduction, because in house property chapter no other deduction you can get. For self-occupied unit you can understand net annual value will become 0 and you will get only deduction of interest on borrowed capital under section 24 clause B, that too percentage wise. Whatever is the percentage which is belonging to the business, that is not to be called as a house property, but any expense related to that business unit percentage wise, it will be allowed under the head PGBP and it will be deducted from your business income. I hope you understood. Then question number 3B, 4 marker question were there, 2 marker small capital gain wala point. First of all, they have asked about listed equity share on which at the time of purchase and sale both you have paid security transaction tax, and those shares were acquired prior to 1st February 2018. The only relevant point is how to determine cost of acquisition. It is as per section 55 subsection 2 clause AC, which is higher of actual cost or lower of full value of consideration or FMV on 31st January 18, whichever is lower, or actual cost, whichever is higher. That cost without indexation, deduct from full value of consideration, balance will be your capital gain. There will be long-term capital gain in the question. Second point that they have asked is, in that residential building is there, to calculate the full value of consideration, section 50C will be applicable, in which if stamp duty is more than 110% of actual value, that stamp duty will become full value of consideration. And if the gain is a long-term capital gain and you invest the money in the bonds of National Highway Authority of India, you will get exemption under section 54 EC up to rupees 50 lakh or capital gain, whichever is lower. The C point that they have asked is again of 4 mark, but it is of slum sale, a very small question of slum sale. As you can see, total capital gain they have asked for 8 marks. Now, if you see JKC textbook, we have put total 2 to 3 questions of slum sale. One big question is there, and in homework section also we have drafted a question on slum sale. Here there is a very small version of slum sale. Section 50B, whatever you are receiving at a consideration, that will become full value of consideration. Deduct the expenditure. From that you have to deduct net worth without indexation. In that, asset minus liability. Those asset on which depreciation has not been provided, you have to provide the depreciation and then take it into the net worth. And the liability which is now liable to be repaid, which is belonging to that business, that you have to deduct from the net worth. And that net worth you have to deduct from full value of consideration, that is net consideration. Balance will be your slum sale. Question number 4A. Now, I can say that this question, entirely this question, only figures are changed, directly given in JKC textbook. In the chapter clubbing. See, in this clubbing provision, what you had to remember. First of all, clubbing is to be done in the hands of, there are 2 persons over here, Mrs. Anandi and Mr. Dharmesh. Father and mother, whose total income except this minor's income is higher. In that person's hand, you have to club the income. While clubbing the income of minor, remember, the person who is suffering from disability of ATU, his income will not be clubbed. Any other income which is derived from the special talent, that is also not to be clubbed. However, if from that amount any fixed deposit is made and interest on fixed deposit is generated, that interest is always taxable. It is always to be clubbed. Only the basic income which is related to special talent, that is not to be clubbed. Gift income is given in the question. If not exceeding 50,000, then how it can be taxable in IFOS? Section 56(2)(10). Scholarship income is given. Or scholarship income is exempt under section 10 clause 16. However, from the fixed deposit made from that scholarship income, the interest you are getting, that is to be clubbed. While clubbing the income of minor, section 10 clause 32 will be applicable, wherein 1500 per annum per child, a standard exemption up to the income is given to the parent in whose hand the income is going to be clubbed. Now, very proudly I can say 4 clause B set off carry forward. Again, this similar kind of example is given in JKC textbook. What points you had to remember for this? House property loss you can set off maximum up to rupees 2 lakh against any other head, not more than that. Balance loss you have to carry forward. Internally you can set off any amount, outside house property head you can set off maximum up to rupees 2 lakh 71B. Second point which you had to keep in mind while solving this question, non-speculative business loss can be set off against speculative income, but speculative business loss cannot be set off against non-speculative income. Third point, short-term capital loss can be set off against long-term capital gain. And last, horse races का जो loss है, whatever is the loss of horse races, you cannot, set off against any other head. You cannot set off any other losses against the casual income also. That has to be directly taxable. Then, as per again their tradition, 4-marker question was there from assessment procedure chapter, a theoretical question, literally very easy. This question, again there, JKC textbook, provision of this second question directly given in JKC textbook. So, I can say that entire paper was covered by JKC textbook. If we see this section B other than MCQ, because MCQ is not on a record, that's why. Now, the first point that they have asked, the theoretical question, that what if you file your return of income after 139 subsection 1? Remember, if you file your return after 139 subsection 1, you can carry forward only 2 losses, house property loss and unabsorbed depreciation. Otherwise, balance losses you can set off, but you cannot carry forward. Second, a person whose gross total income before claiming capital gain exemption exceeds basic exemption limit need to file the return of income. If any asset, including any financial asset, is owned by resident and ordinary resident outside country, then again he has to file return of income in India. And if during the year electricity expense exceeds 1 lakh, then also in this year that person has to file return of income. So if you don't want to see the suggested answer of this paper, you don't have enough time, this one PDF will help you out to reach out each and every small points that were covered in July, that is May 2021 examination of ICAI Inter CA Direct Tax. Thank you so much.